Hello, everybody. Welcome. Hi, Charlotte. Hi, Cheryl, Morgan, Dory. Hello. Hope you guys are having a great day. I'm excited that you're here. We are going to talk about some much needed info for our businesses as we are managing cash flow. So let's go ahead and get started. So today we're going to talk about cash flow management strategies for seven-figure business owners. These are definitely strategies that any business at any size can use. Some are going to be more applicable to higher volume of transactions, higher revenue, all of those things that seven-figure businesses have, but definitely can be used across the board as we're going through. So let's go ahead and get started. For those of you who do not know me, my name is Andrea Jenson. I am the founder of the Cash Flow CFO, where we help entrepreneurs to understand their numbers, increase profitability of their business model, and really have the ability to make decisions from data and help them to achieve the revenue goals that they're after and also the profitability in their business. I'm also the creator of the Predictable Profit Accelerator. It is a method that we use when working with our clients to help them achieve those goals, and recently named by Forbes and Success Magazine as a top 10 business strategist for a scaling company. So those are a little bit about me. I've got two daughters. I love to play soccer. That's my stress relief as all the different things that we do in our business. It really is important to understand, what are some of the symptoms that we come across in managing our cash flow. So some of the things that you might be experiencing in your business right now are looking at maybe you've got credit lines that are maxed out or are getting close to being maxed out. You might be scrambling to meet payroll, for your team, and that also might lead over to paying your suppliers, your vendors. You might have late customer invoices. And ultimately, you might be missing growth opportunities. And so these are some of the symptoms that you might be experiencing in your business right now. And, those are the things that as we go through these processes, we're going to show you how to remedy each of these different situations. You might be feeling like you're pulling your hair out because cash flow is something that's cyclical, right? Every month you might be dealing with these same things that just keep popping up. And ultimately what we need to do is get to a point where we're fixing the root cause of these issues in our business. And that's what we're going to talk about today. So I want you to feel like this when you look at your P&L, when you look at your bank statement, right? Thumbs up, everything is going good. And in order to do that, there's a few things that I will show you today that if you implement into your business, you will be happy as this guy. All right, so diving right in, step number one, we're going to look at how are you identifying the cash inflows and outflows in your business? So how are you looking at and tracking what is coming in? So a lot of times, business owners, they go back and forth on accrual accounting versus cash accounting, and what is the difference, and why do I need one versus the other, and my taxes are on cash basis, so how does that work to be on a managerial version of accrual basis in my business? And really what it boils down to is when you are tracking cash inflows and outflows, if you are using a cash basis method of accounting, you're not seeing what's coming up around the corner. You're only seeing what's happening right now in your business, and it prevents you from knowing what's due to me. So for example, accounts receivable. If we create an invoice for a client and we give them payment terms of 30 days, if we're just looking at on a cash basis of accounting, and we're not able to see that something is due to me in 30 days or 60 days or whatever your terms are with your clients. So it's really important to understand your cash inflows, what's happening now in my business, and then what's going to happen in 30, 60 days, and having that visibility. And the same thing goes for outflows. So we want to understand, who do I owe money to and at what time period, so that I can plan and manage my expenditures. So I'm timing my inflows with my outflows in a way that smooths out my cash flow in the business. So a good tool to use for that is to have a cash flow forecast. Now, a cash flow forecast is just what it sounds like. It's going to be a tool that's going to help you to update your cash coming in, cash going out, and put it all in one spreadsheet so that you're able to look at and identify, are there going to be any dips coming up in being able to meet your obligations as the business. So anticipated shortfalls. It allows you to be proactive, right? So you can say, oh, in 3 months from now, based on the activity that's happening in my business, it looks like I'm going to have a little bit of a cash shortfall. I'm going to make sure I have a line of credit in place or something that's going to help me get through that period to cover any gaps. So you're able to be in a more proactive role versus reactive and just having to scramble to make ends meet, which, as business owners, that creates a lot of stress. That creates a lot of anxiety, and it inhibits you from running your business in the most productive way. So it's a cash flow, a financial planning tool that you should definitely have in your toolkit. And it's going to help to predict and manage cash inflows and outflows. It looks like this. And I'm happy to share this template with anybody that would like to get this and use it for your business. But ultimately, when we talk about cash flow in our business, one thing that always trips up business owners is understanding operating cash activities, financing activities. Oh, excuse me, I have a sneeze coming. And also understanding how they all work together. So if we just looked at our financial statements, if we just looked at our profit and loss statement, for example, and use that as a tool to forecast operating expenses, that's not taking into account if we have any debt that we're servicing. So a lot of business owners right now have idle loans. They might have a line of credit. They have maybe some SBA Express working capital loans, things like that. Those are going to be how it's just one piece of the puzzle, right? The P&L is only telling you what's happening in cash coming in and cash going out for operating activities. It's not bringing in anything that happens on the balance sheet. So if you buy a new vehicle or you buy more inventory, that's not going to show up on your P&L. That's going to live on your balance sheet. And so having something like this as a tool, what it's doing is it's compiling all of those activities that happen on the P&L and the balance sheet and putting them in a way that you can manage the cash flow happening in your business. So what we have here is you would put in your operating activities, how much money you received in cash, how much you spent in disbursements, and then you would have a net amount that then carries into investing activities. Did you purchase any fixed assets? Did you sell any fixed assets and generate revenue from that? And that's going to give you a total there. And then, financing activities. Did we pay on a loan? Did we have any distributions? A lot of times as business owners, our comp package, if you will, or how we're paying ourselves has to do with a mix of payroll and taking distributions or dividends, depending on your entity type. That also needs to be tracked here because it's movement of cash in the business. And so that's going to give you a total net from each of those three sections. And then that's going to tell you, how did that change? So you've got your beginning cash balance up here, the activity that happens, and then what's your ending cash balance. And then that's going to roll over to the next month as you're starting, and the same things are going to happen. So this is a really great tool to consolidate all of the activities happening in the business and have one clear picture on what's happening with your cash flow. So the next thing we want to do is we want to monitor and we want to forecast what's going to happen. So you can look at your cash levels to make sure you're avoiding any overdrafts or missed payments. If you're in a cash flow crunch at the current moment, this is what you would want to be doing. If things are good and you've got a surplus of cash in the bank, you don't need to be doing this level of analysis. But if you are in the thick of it, then this is something that you'll want to do. We also want to get into a position where we can do scenario planning. So right now, there's a lot going on in the world that's outside of our control as business owners, but we want to have peace of mind knowing that I can plan for what if scenarios. So, for example, if you're bringing in your supplies or your inventory, and now there's an additional 15% tariff, just for an example, you want to be able to layer that in and see, how is that going to affect my cash flow forecast, so that you can have a plan in place. If this, then I'm going to do this, because I know how it's going to flow through to my cash flow. And really what that's doing is that's putting you in that proactive position, so that you've got peace of mind knowing that whatever might happen out there that is going to affect your business operations, you've got a plan in place and you can easily implement that plan should you need to, and you'll know how all of that is going to affect your cash in your business. The other thing that you can look at are different ways to enhance your cash inflows. So this one is a very tangible, easy thing to implement in your business. And ultimately what we are looking at here is we want to improve collections. So when you send out an invoice to your client, they owe you money. And you want to make it as easy as possible for them to pay you that money. And preferably, if you can incentivize them, they might pay you that earlier than the terms that you've outlined for them. So, for example, you can offer a discount for early payments. And so, a lot of times, what that looks like is you could give a 2% discount on the invoice if they pay net 15. So instead of waiting the full 30 days, they're incentivized to pay that bill, in a shorter period of time, which is going to speed up the inflow of cash into your business. The other thing is to implement stricter credit terms. So a lot of times, especially in a smaller business where, you might be delivering service, billing, and then following up on collecting it, it makes it a little bit tricky. But by having strict boundaries around your credit terms and how you are monitoring and staying on top of those is really going to greatly enhance your cash inflows. So having an automatic email reminder that goes out maybe a week before an invoice is due, just reminding clients, offering a link to make a credit card payment, or ways that we can make it easier for them to pay is what we want to look at. But if an invoice becomes due, we have to be staying on top of those and finding solutions that will help the client to stay within the terms you guys have agreed upon. The other thing, is looking at this is a standard aging report, right? You've got your current invoices, 1 through 30, 31 through 60, and so on. It's looking at this on a weekly basis and making sure that you don't have the 61 to 90 and 91 and over happening, and that everything that's in the 31 to 60, you're in communication with that client and you're staying on top of it. So this is a really important tool to make sure that you are utilizing in your business, and it's part of your weekly review of your cash flow management. The other thing that we see happen a lot of times in businesses, especially service-based businesses, is there's sometimes a gap between the period of time you've completed work and the amount of time it takes to actually get that invoice out the door and to the client. So if you think about it this way, if you finished work, you have to pay your team in the same amount of time that their payment, their payroll schedule is. But if you take a week before you actually get that invoice over to the client, now you've just made your invoice 30 days plus a week that you're giving them time to pay you. But you've already had to pay your team, and so now you're becoming the bank. So it's really important to, as soon as that work is completed, get that invoice out to the client to start that clock ticking for their payment terms that you guys have agreed upon. The other thing that you can do is to negotiate upfront payments. So you might take a deposit, 50% due at the time of signing, and then 50% due on payment terms. That's important. If you have a long-term project that is going to span multiple months, you need to make sure you're building in progress payments so that you are not, as the business, paying your team for work that's been delivered and not getting paid for 3, 6, 9 months, depending on the length of the engagement. So it's really important to build that into your proposal, build that into your processes so that you're not becoming the bank in your business for all of your clients. All right. The other thing that we can do to enhance our cash inflows, the money coming in, is we can increase our sales and marketing efforts. So looking at, maybe there's some low-hanging opportunity in your business and you just need to spend some time and focus on it. That's really important. If you are tracking your marketing spend and you're looking at the conversion rate of that turning into a sale, then you can reasonably predict, if I spend an additional, amount of money on marketing, that's going to generate an additional amount of leads, which I can count on based on my historical sales conversion rate to generate X number of revenue. So it's just keeping your finger on the pulse of all of those metrics so that when you need to, you can quickly increase your sales efforts if you need to bring cash into the business quickly. The other thing that you can do is you can look at your balance sheet and identify, are there any assets that we're no longer using? And you can sell those, you can rent those. Anything that is underutilized, you want to get it off your books and get some money in the door for those assets. The other thing that you can do is you can offer incentives. So we talked about this a little bit on an earlier slide, but discounts, promotions, things that are going to encourage faster sales and a quicker cash turnover. Those are things you want to implement in the business. So the next thing we want to talk about is how to manage outflows. So we talked about how to bring money into the business. Now we want to talk about how are we going to slow down the money going out the door in the business. And the ultimate goal here is that we're matching up those timings, right? If you're giving your clients a 30-day term to pay you for services rendered, you want to try and match up your cash outflows for 30 days of when you're paying those bills. So one thing you can do is negotiate extended payment terms with your suppliers so that your timing is more in alignment with when you're receiving the money in. And most suppliers, they're willing to give terms. And as long as you're sticking to your agreed upon time frames, then it shouldn't be an issue for you as you continue to grow and scale your business and get better terms in place. The other thing that you can look at to slow down the outflow of money in the business is to prioritize your expenses. So you want to focus on those essential expenses and then defer. So we want to push off anything that's not essential. So for example, if you're looking at, investing in maybe some coaching for your team maybe that can wait a month or two until the cash has been collected from any clients that you gave payment terms on. So we want to just kind of identify what is absolutely necessary as an operating expense, and then what is a discretionary expense that can possibly wait. Another option here is when you're looking at fixed assets, you could lease instead of buying. Oftentimes, a lease is going to be less than what the terms are that your monthly payments would be if you were buying it outright. And so, if we utilize leasing equipment or property instead of purchasing it, that right there is going to help you to manage the cash outflows. And it's not to say that that's the perfect long-term strategy, right? This is just when you're having cash flow crunches in the business. It's something else to consider when you need to get those bigger pieces of equipment or property, things like that. The other thing you can do is to negotiate with your vendors. So you can ask them for more favorable terms. So maybe it's a discount, or maybe it is extending out 30, 60 days to pay those invoices. And a lot of times your suppliers will work with you because they want you to succeed because you're their revenue stream, right? So they're willing to work with you, and they're motivated to find a solution that works for both of you. The next thing to do is to go into reviewing all of your subscriptions and your services. And I think that a lot of businesses don't realize either their team is signing up for software or different subscription services, or they are. I know I'm guilty of this. And then I look at my P&L a month or two later and go, what did I sign up for? Oh, I'm not even using that. Let's cancel it, right? Those are all opportunities to plug money leaks in the business. And so what we do with our clients is we do what's called a highlighter review. And we go through their P&L, their general ledger. So we print out, pick a period of time. We like to go back at least 90 days. And you'll run a detailed general ledger of your expenses. And you'll go through line by line, and using Excel, you'll highlight all the necessary expenses that are like, yep, we still use that in the business. It's necessary. We'll highlight that in a green highlighter in Excel. If it's something that we look at the line item and we go, gosh, I don't even remember what that is, or I don't know who purchased that, let me highlight that in yellow. And that means I'm going to dig deeper into finding out what is that expense line item. And then if we highlight it in red, it's something that, oh, we can cancel. Let's cut that expense right away. And then you can bring that to your accounting team, and they can go ahead and implement that for you. So that's a good way to, on a quarterly basis, be monitoring our cash outflow for subscriptions and services, and make sure that we're still using everything we thought we would, when we signed up for it. The next thing is to look at our inventory. So if you have inventory in your business, I want you to think of it when you picture seeing that inventory sitting on the shelf as dollar bills stacked up on your shelf. Because essentially what that is it's money that is spent. It's sitting on your balance sheet. It's not on your P&L yet. And it's just inventory waiting for you to be able to move it out of your business, sell it, then it'll show up on your P&L. But if you could get your inventory levels to just the right amount for what you need based on your sales activity, you're going to prevent having a lot of buildup of inventory and ultimately cash sitting on the shelf. So just-in-time inventory is one of those tools that you can use. But ultimately, the goal here is decrease those levels so that your cash isn't tied up in inventory or excess inventory. So the next thing to talk about is improving your profit margins. So if you look at every dollar in revenue that your business generates, it's got 4 big buckets essentially that it gets divided up into. And those 4 big buckets are going to be your cost of goods sold, or cost of revenue if you're a service business, your general and administrative expenses, your marketing expenses, and your profit. Now, when we look at the cost of goods sold and compare it to the revenue, we want to get that profit margin as high as possible, because what that does is it gives you all the money left over for the other buckets in the business, right? For your general and administrative, for your marketing, and profit. And the reason that I consider profit a spending bucket is because if you see profit on your P&L, it doesn't mean that that same dollar amount is sitting in your bank account, right? Profit actually gets spent in the business. And the things that it gets spent on are income taxes, right? We're putting money aside for paying our income taxes in the business. We are putting money aside to reinvest into growth, right? That's not an operating expense, it comes out of profit. We are servicing existing debt. So that principal payment that we make on our debt every month doesn't show up on the P&L. The interest portion does, but not the principal payment. And the last thing is to service the owner's comp. So whether that's a distribution or a dividend, depending on your entity type, all of those things, those four categories, come out of your profit. And so that's why there's a lot of disconnect between between what the business is generating on the P&L and what's actually sitting in the bank account, right? Those two numbers hardly ever match up. And if they do, it's just a fluke in timing because that money is going to get allocated to those other activities. So if you look at your profit margins and you're able to increase your sales price by 1, 2, 10, 12%, whatever your market will bear, that is just going to fall straight to your bottom line. And so that's going to create more cash flow in the business. And so looking at each of your revenue streams and trying to identify, when we talk about pricing, it's definitely an art and a science, right? So the science piece of it is how much you should be charging based on how much it costs you to deliver the service. The art is what will the market actually bear before we start to lose customers or our buying slows down. So you'll want to look at both of those. But if there's a way you can increase prices and train your customers that you do that annually, you review, the cost for you guys as a business to deliver that service you're selling, that's going to make sure you have the right margins in the business. So we talked about reducing our cost of goods sold. You can negotiate better rates with your suppliers. You can look for other suppliers that might be able to be more competitive with the price that they're charging so that you can reduce that cost of goods sold to increase your profit margin. The other thing that you can look at is, can I upsell or cross-sell? I've already paid to acquire a customer. How can I serve them in other ways that is going to increase the average transaction value? And this is really important to look at and should be part of your everyday business model, is that customer acquisition cost is no small amount for any business. And so the higher you can get that average transaction value, then that means that's going to fall to your bottom line, because you're not going to pay to acquire another customer. You're just going to sell more to the ones that you already have, who know, like, trust. Find different ways that you can support and serve them so that you can increase that average transaction value. The next thing is employee and contractor management. So this is really important to think about and to be monitoring on a regular basis, because we want to make sure that we are only hiring the amount of staff that we need at the revenue level that we're at currently. So a staff utilization schedule is going to help you to understand, based on the current staff that I have, how much revenue can I generate from them? And that's going to help to make sure you're not overstaffed, which is eating into your cash flow. The next thing is looking at your contractor terms. So if you have contractors in your business, you want to look at what are the terms for them. Am I matching up my payment to my contractors based on when my clients are paying me for work that they're delivering? And just see how you can negotiate a more favorable payment terms with your contractor so that you're not being the bank there again saying, I'm going to pay you within 15 days, but my clients don't pay me for 30 or 45 days. That's a big gap for you as a business to have to manage, and will cost you money if you're having to dip into a line of credit and pay interest on that in order to facilitate those terms. The next thing you can do is, if you are in a cash crunch and it's a dire situation, you can look at considering temporary pay adjustments. So this could be a reduction in hours that your team is working. And it's always important that if you are going to implement something like this, you're very open and honest with them about how long you anticipate it to last, the reasons why, what you're fixing in the business so that this doesn't happen again. That's going to make sure that they don't go out and start looking for other work during this temporary period in your business. The next thing you can look at is identifying what opportunities are available to you for short-term loans. So it could be, a line of credit, it could be a bridge loan, it could be the SBA Express has working capital loans that you can apply for. But it's important to understand, and also you want to have something already in place before you get into a cash flow crunch. So you want to look at what could I potentially need in a dollar amount, and go out and secure that while your cash flow is strong, your P&L looks really good and healthy. Those are the times to get financing in place. But if you are in a cash flow crunch and you don't have financing already lined up, start having those conversations with your banker so that they can show you what options you have available. The other thing that you can do in your business is utilize different financing options. So you could have a sale leaseback arrangement that would help you to generate cash without losing your essential equipment or property. So basically, you could sell it to somebody that is interested in becoming the owner of that asset, and then you can lease it back from them. And so you should be basically reducing the amount of a principal and interest payment that you were making, and your leasing should be more advantageous, so the price would be lower there. We talked about a line of credit. You want to have that in place so that you can access it when you need to. You can also factor your receivables. I don't love this option, but it's definitely one that is very widely used in businesses, and specifically certain business models and industries use this tool more than others. But essentially what you're doing is you're selling your accounts receivable to a lender, a factoring company, and they pay you. So they'll give you 70 to 90% of that invoice in cash today. And when you collect the money in 30 days or whatever your payment terms are with your customer, then they will pay it straight to the factoring company. And then the factoring company will take their fee. And then if there's anything left over, they will pay that back to you, the client. So it can get expensive, and it's also a little bit tricky to get out of a factoring engagement once you're in it, because your business is relying on that cash up front when it's falsely propped up. So it's just something to keep in mind, but it's definitely an option that is very widely used. Another thing to look at is maybe it's time to downsize or relocate. So you might consider moving to either a smaller location or a less expensive location in order to reduce your rent and utilities. That's going to have a big effect on your bottom line and increase the available cash flow in your business. So the next thing we can look at is reducing overhead costs. So when we want to reduce our overhead costs, we want to look at how can we outsource our non-core activities. So some of these functions, HR, IT, accounting, those are going to reduce your staffing costs, and they're going to provide you, like for example, our company is fractional. So we're providing the amount of work that your business needs at the time and at the level you're at, and you're not paying for a full-time person and not actually needing all of that labor. So that's a good thing to look at, is how can I outsource some non-core activities in your business. The next thing we want to do is to build and maintain cash reserves. So if you're in the middle of a cash flow crunch, this is going to feel really heavy and tricky for you, but you ultimately want to get to the point where you have this reserve. And when we identify the health of a business and a business model, it is that they have a 3-month emergency cash reserve buffer in place to protect on those ebbs and flows of maybe it's a surprise decline in sales, maybe a big customer is late paying you, right? You want to make sure that you've got an emergency reserve before you have to dip into your line of credit or some other type of financing that's going to cost you more money. And the other beautiful thing about this is that you can put this into an account that's going to pay you interest. So there's lots of options out there. One that we really like is an account called Leafy, and you can earn interest on your cash reserves, but still have it when you need it. You can get it back within, the next day, business day. So that's important to look at. Your retained earnings. You always want to be, when you're in a position to do so, to reinvest your profits into the business so that you're building that stronger financial cushion instead of constantly draining the cash out of the business. So that's something to look at. The other thing that you can do is leverage technology, right? We want to create a financial pillar in your business that part of your business model is you're automating where possible, right? Where do you not need a person to do a process? So we can look at software to automate your invoicing, payroll, expense management, and it has a lot of benefits, right? We're reducing errors, we can speed up processing, and typically these costs are going to be fixed. So as your revenue increases, these, labor would increase in lockstep with an increase in revenue because you'd have more that would need to get processed. Technology will save you from that. So it's a great way to put in a process that is scalable and it's a fixed cost. There are some cash flow management tools out there that are going to allow you to, in real time, understand the cash flow activities in your business. So, for example, we have a service that we offer that is a dashboard, and it syncs with QuickBooks. And in real time, when a change happens in QuickBooks, your cash flow forecasts are updated. So there's a lot of things out there. That's one of them that you can implement in your business to have, we don't want you to wait for the month to close, plus the 10, 15 days it takes for your accounting team to finish your books to then look at it and go, oh, shoot, we should have made this change 22 days ago, right? We want you to have that real-time access to the data. So there you have it. We have gone over the 10 strategies for managing cash flow in a scaling business. And, in my experience, in all my years of working with business owners, it's, absolutely true that a scaling business eats up cash like no other, right? It's a constant, you're fixing, as you grow your business, you're fixing a new process, you're hiring a new team member. And without having that clarity and your arms wrapped around the cash flow in your business, then it really hinders your decision making, and it hinders the ability and the speed of which you can continue to scale the business. So hopefully, of those strategies, you are able to implement, ideally all 10 of them, and just make a list of them and prioritize in which order are these going to have the biggest impact in my business, and continue to implement those. And for our clients, or for our webinar attendees, and if you've stayed with me through this far of talking about cash flow, then we want to give you a special offer and a reward for doing so. So what we have today is our cash flow clarity package. And essentially what we designed this to do and to provide for you, the business owner, is a way to understand, how does the cash work in my business? What are my inflows? What are my outflows? And what is impacting both sides of that? So this review is designed to streamline your cash flow, to boost your profit, and to help you scale smarter. And what that includes is a 90-minute deep dive financial analysis and a personalized report that we identify what are those key growth opportunities. And we're also going to uncover hidden profit leaks in the business, inefficiencies, things that are sucking the cash out of your business and creating these constraints and the stress on your cash flow. And in addition, we'll do an assessment of your current financial management practices. A lot of what I went over today are things that you need to build into your business. And so we will assess how are you doing that now and make some recommendations for you on how to improve upon that, so you don't find yourself in a cash flow shortage in your business, because we all know that that is not where we want to spend our time and allow our headspace to be overtaken as a business owner. So all of this amazing financial analysis in our cash flow clarity package here. We have a special webinar pricing. The total value of the service is $3,497, and today we are offering it for the low, amazing price of $497. The reason that we're providing the discount is because if you're having cash flow problems, you're likely going to look at the 3,000 and say, oh, I can't do it, but I can do 497. And that's going to provide you so much peace of mind and clarity, and really help you to get from where you're at now in your business to where you are in a position of being proactive with your cash flow planning and strategy, and help you to get past that and have a solid financial footing and foundation in your business, so you can continue to scale and grow and run a fun, profitable business, which is what we all want. So there you have it. Thank you guys so much for your time today. I hope you found this valuable. Reach out. We'll have the link to purchase this package in the notes, and you'll be able to get access to that. And hopefully we'll have the opportunity to work together and support you in your business.